Why I love value stocks. All right, so value stocks are ones that are beaten down, and thus they're inherently more risky, or riskier, I guess is the proper English way to say it. The the interesting thing is, a lot of people think value stocks are less risky. Nothing could be further from the truth. So I'm going back to my book on The Forgotten Depression by James Graham. He's talking about some stock. I forgot what the one, GM. In 1921, it was trading at like 3 times earnings, a 7% yield, something like that. Anyway, it had negative earnings the year before. I can't remember the whole point. But no one's going to buy that stock. And the reason is because the earnings had fallen through the floor. It looked gloomy. They laid off a bunch of people. Even the people still working were only working 3-day work weeks. 3 days. They could only get 3 days of work. That's all the demand they have for the products, because the economy was just in tatters. And so what they're expecting to get 5 or 6 day work weeks, they only get 3 because there just wasn't demand for their goods. So you're sitting there thinking, would you buy GM? Would you buy GM then? A lot of people wouldn't. A lot of people are nervous about it. They're like, I don't know, man. They haven't made any money last year, or they made a lot less than they did the year before. They're laying off people. They're not getting the orders. I don't know. But price to earnings are only 4. Price to book is a third, 0.33. The dividend yield is 6 to 7%. Yeah, but there might be a reason for those numbers to be the way they are. Maybe the stock is going to go bankrupt. And so that is inherently why value stocks are more risky, because there's a reason they're beating down so much. Which is why you never just buy one stock. You buy it in a mutual fund or ETF, like VTV, the Vanguard Vanguard Value Index. But I'm telling you, so at the end of the day, you're like, all right, valuations are what determine future returns, without question. All right, so valuations. So the higher the valuations, the lower future returns are going to be. It doesn't happen overnight. There is something called the trend and momentum, but trend and momentum always stops. So if you have a high valuation stock and they're making more and more price relative to each dollar of earnings because they're making money, just going back to the growth index versus the value index, the growth index is trading the last 5 years at 300% more earnings growth year over year than the value index. So a lot of people say, oh, the value index is poor. From a growth perspective, over the past 5 years, it has been, without question. But that is a trailing 5 years, a trailing 12 months, TTM. What's our future projections? Well, if you're going to base your future projections on the last 5 years, it's going to look pretty sparse. You're like, if we only got 5% a year earnings growth year over year, actually it's even a little bit less than that, we'll assume that you're only going to get that going forward, as they would have done at GM in 1921. But then, lo and behold, kaboom! Something happens and GM just took off like crazy, and the shareholders made bucks. And so that's the issue with value stocks. They're going to go one of two directions. They're going to go kaput, or they're going to go up. How long it takes to figure that out, I don't know. So you got to be in there for the long haul for sure. But again, one reason why you buy baskets of stocks, not just 1 or 2 stocks, because if your bets are wrong for those 1 or 2 stocks, you're doomed. But anyway, so value stocks, you're buying when they're cheap, you're buying when they're beaten down, you're buying them when no one wants to touch on 10-foot pole because the earnings are bad, the inventory has been depleted, and yet they're not getting the orders to replenish the inventory. They're laying off people. The workers that keep are only working 3 days a week as opposed to 5. All these things are conditions of value stocks. But if the value stock can make it, you can make a lot of money, for sure. Ben Graham apparently bought DuPont because DuPont owned, I think it was the largest shareholder for General Motors back in the 20s. And Ben Graham saying, look, if a DuPont stock is trading as if the only thing it owns is GM, it's trading as if the DuPont company itself is worthless. And he goes, so I'm going to buy DuPont stock so I get the benefit of GM stock, plus I'm getting value for DuPont stock itself because the company actually has profits. So that's what Ben Graham did. He just he said, I'm not going to buy GM, I'm going to buy DuPont. I basically get 2 for the price of 1. A significant value there. You know, DuPont was trading at like lower than cash flow. So I mean, the money it had in cash, the share price was lower than the money it had in cash. And Ben Graham says, yeah, that doesn't make any sense. Anyway, that's why I love value stocks. You know, you got to be in there for the long haul. You got to recognize value stocks are inherently more risky because there is a chance these stocks could go kaput. That's why they're trading at so low premiums relative to earnings. People just don't want to buy stocks that aren't growing their earnings growth year over year. They don't. They get nervous. They don't want to buy stocks that the price has been beaten down. It makes them nervous, or the companies are out of favor. So that's where you can make the money. But people don't want to buy that. They want to buy the Amazons of the world because the growth. They're like growth. But if you want to make money, valuations determine future returns. All right, we'll see you then.